So before we proceed to discuss amendments in other laws, we have last session waiting on income tax, a crucial one, which will cover the topic transfer pricing. So to quickly guide us through the recent amendments, we have joined by Mithilesh Reddy, founder and CEO of Steadfast Business Consulting LLP, SBC. Mithilesh brings over 15 years of extensive experience in transfer pricing. He's specializing in advising multinational enterprises on three-tier documentation, transfer pricing, litigation support, and complex intercompany transactions. The expertise include transfer pricing structuring, controversy management, global benchmarking, compliance, advisory services for APA, MAP, and BEPS. Mithilesh diverse client base spans sectors such as technology, industrial, pharma, financial services, and consumer goods. A very good evening, Mithilesh.
Yeah, hi. Very good evening.
So how have you been?
I'm good. I'm good.
So now the session is all yours to take.
Yeah. Can we start?
Yeah. Would you be sharing the screen? Yeah. Okay.
So it's visible?
Yes. Could you put it in the slideshow mode?
Is it fine now? Yeah.
The slideshow mode isn't visible right now.
It's fine now, I think.
Yeah.
Yeah. Okay. So hi everyone, the Mithilesh here. So we'll quickly get through the amendments. There are almost like 9 amendments that have come, specifics to transfer pricing, wherever the references to the transfer pricing provisions can be made and where exactly it is going to impact the transfer pricing assessment, as well as the specific aspects of Section 92 or Rule 10. We'll have 8 things discussed in overall perspective. One such important amendment is the SDT provisions. What exactly happened in this specified domestic transactions earlier, before this amendment and after this amendment, we'll just quickly run through. In the existing provisions under Section 92 CA, wherever the reference to the transfer pricing officer was being made by the assessing officer, the transactions pertaining to international transactions were specifically having any other international transactions where 92 CA 2A and 2B had not been extended to SDT provisions as such. So whenever a international transaction gets referred to the TPO, the transfer pricing authority had the power to get into any other international transaction where the reference was not made as such. So once a file is referred to him, if only a specific international transaction is referred, he can get into any other international transactions where the specific reference for him was not made, because 2A and 2B of 92 CA had this reference of any other international transactions per se. Now, this section is amended by the current provisions, saying that the TPO will have authority to extend this particular reference for a specified domestic transactions to any other specified domestic transactions also, which have not been referred to him for the transfer pricing assessments as such. So any SDT file that comes to the transfer pricing authority, he can get into any other international transactions that can be, any other specified domestic transactions that have not been specified by the scrutiny parameters or by the assessing officer or by the internal reasons why this particular file is picked up for transfer pricing assessment. With this amendment as such is important from a transfer pricing assessment per se, is because of the fact that most of the SDT files or the domestic transfer pricing files have been skipping through the nose of the authority, or even if the authority goes and does the adjustment or goes into any other specified domestic transactions, assessees were always contemplating with this particular section, saying that you cannot go into any other specified domestic transactions other than the ones that are referred. So they have blocked this, loophole in the law by including the specified domestic transactions also. For example, if at all ABC is a tax-paying unit or a tax-paying entity within a group, they have royalty transactions as well as purchase or sale transactions. So the sale and purchase transactions are part of the reference, but royalty per se is not part of the reference. Then the TPO can get into the royalty transactions also. So there was one judgment of Ahmedabad which said that it is directed that even if AO failed to make TP reference, he can consider the TP adjustment proposed by the TPO while passing the final assessment order. But this specifics were not there within the act if the SDT transactions were not there. So there was a specific intention behind this. There was an expansion of the scope for the transfer pricing authorities. It's a very good amendment. Only thing is, wherever there are specified domestic transactions, they have to be very careful in terms of, disclosure of specified domestic transactions and also declaration of the arm's length. There has to be a specific indication that there should not be an excessive or unreasonable profit making in any of the transactions per se, and all the transactions have to be disclosed. And if any transaction is not disclosed and if it is not being referred by the authority also, transfer pricing authority can get into any specified domestic transactions from 1st April 2025. Now, what exactly happens with this SDT transactions is the entire jurisprudence will get covered for the transactions, even if they are not reported by the assessee per se. And it ensures that there is fair market practice. It ensures that there is less dispute. The TPO making the adjustment, assessee saying it is not covered by the act. So they have plugged in all the loopholes with one amendment saying that it extends to specified domestic transactions also, 92CA2A and 92CA2B. Safe harbor rules have always been the part of, dispute resolution mechanism. The first amendment, the first introduction of safe harbor rules as such has been done in 2013. In 2017, there has been an amendment. What exactly are the safe harbor rules? Safe harbor rules is a indicative margin given to a specified set of transactions, specified set of activities being done by the related parties in a group. If the transaction falls within the definition of such definitions indicated by the safe harbor rules, and if you maintain the margin specified by such safe harbor rules, then the authority can give you that safe harbor order or the exemption from transfer pricing assessment. So for ITITs, the Rule 10A to Rule 10HD specifies that if you are not more than 200 crores, if you are more than 100 crores and 200 crores, there are specific indicative numbers of 17 and 18%. So there are specific transactions of ITITs. I'm just giving you a rough example of only ITITs per se for the sake of simplicity and easy understanding. So if you are falling within the definition of IT and if you are maintaining 17% and if you are less than 100 crores or 200 crores for 18% also, then the definition per se, the margin and how the coverage happens, and you are avoiding the transfer pricing assessment. So this is called as a dispute resolution mechanism, alternative to the exposure to the transfer pricing assessment. So these safe harbor rules were introduced in 2013. They were amended in 2017. Now there is a proposal made by the finance minister saying that she wants to include the foreign mining company. They wanted to specifically include the safe harbor rules for foreign mining companies selling raw diamonds in India. And she has also proposed a certainty in terms of changes or widening the safe harbor rules per se. But there is an indicative expression that the safe harbor rules definitions, the term, and also the coverage in terms of the margins would set to be revised or widened. So we have to wait and watch what exactly is going to come out in a separate notification. But however, They are aiming to reduce transfer pricing litigation. They are aiming to widen the scope of the definitions that were indicated. They are aiming to make it more attractive, was the word. So obviously the margins that were set out were were a bit more than what the industry was generally expecting to in 2013 or in 2017. So if the margins are reduced, then there will be a huge benefit for all the foreign subsidiaries staying in India for the definitions that they have announced. So most probably the margins would come down, the scope would be widened, and the definitions would be subsumed, and they would be more inclusive definitions is what the expectation is. And the term earlier in 2013, it was applicable for 3 years. In 2000, after 2017, 2020, 21, 22, they made it applicable for 1 year, where each year the notification or the applicability was kept on extending. So there was only 1 year applicability. So the term also might get increased. This is the industry expectation. So we have to wait and watch for the notification as such. Now for thin capitalization rules 94B, there is a specific section which was applicable which was extracted out of the OECD BEPS provisions also. But this BEPS plan specifically indicated a thin capitalization rules where the loss-making companies were taking a much more advantageous position for claiming the interest deduction. In spite of being loss-making entities, they were claiming the interest element, and they were siphoning away the funds was the normal indication with which this provision was introduced. But specific to IFSC units, they have made sure that to develop the world-class financial infrastructures, the exemption was given to this IFSC units to meet the specific conditions in regulation to the IFSCA Act. This amendment will come into picture in 2025. The objective is that these companies flourish even in spite of being they can take more and more funding, and these interest limitation deductions or the specifics of the thin cap rules will not be applicable to these IFSC entities as such. So the point is, government is in favor. They are giving that exemption. They are allowing them to claim more and more funding. They are allowing them to promote and give them that levy or leverage over and above the thin cap rules also. So it's a very good positive move, I think. And in overall basis, this thin cap rules must be eliminated for anybody who is going to promote employment or generate employment or going to be useful to the country. That is a extension that was expected, but they have specifically included only for the IFSC units. They should have given it to MSMEs or anybody who's a startup kind of a thing also. It should have been extended, but they have not extended that. They have kept it specific to the IFSC units. So rate of foreign companies, 40 to 35% is a welcome move. However, these permanent establishment entities, wherever there is transfer pricing applicability, generally kind of whenever we attribute any transfer pricing, income to a permanent establishment, the specifics of 40% and 2% surcharge, all these elements were very, very high. The maximum marginal rates or the 40% plus 2% plus 5% was a very much higher, applicable rate. But these TP provisions, wherever they are applicable, or the general rate of 40% coming down to 35% will be a very, very good attractive specification, especially where the tax burden on the non-domestic companies earning in India is only 30 or 26%. So they're only at that 9-10% gap right now. And the one more important provision that has to be taken care is that the 2% and 5% have continued to be levied. So there is no such indication that they're going to get down from the surcharge and the 5% where more than 10 crores is there. But only the basic rate or the fundamental rate of 40% has come down to 35%. Now, this can be an incentive is what the language or the provisions are indicating. But from a overall perspective, from a global minimum tax rules or from the indicative perspective, the expectation on the general rate also was they're expected to be reduced, but they have not reduced it for the domestic companies. They've only reduced it for the foreign companies per se. So wherever transfer pricing, amendment, the benchmarking happens for the permanent establishment or for the attribution purposes, 40 to 35% needs to be considered. From a Vivad se Vishwas scheme, wherever the applicability from a transfer pricing assessment or the dispute relating to TP appeals is concerned, the upfront payment needs to be made. Wherever the SSC was a appellant as on 31st January 2020 was the indicative number that they have given. But in my understanding, in my specific experience, practical experience, most of the TP litigation gets nullified at the ITAT or a high court. So depending on the more likely than not scenarios or the past litigation, or if it is covered, then most of them may not go to VSV. They would fight it out and get it cleared. But from a TP angle, if you see the Vivad se Vishwas scheme, they may not be going, if at all, the coverage of the specific comparable issue or a guarantee or a receivables, or there is any specific issue, AMP, there is any coverage that is already available. And if the jurisprudence is available, then they may not go for an upfront payment and try to settle this. But from any other issues which is complicated in terms of not having a judicial precedent in favor of them, I think most of them might go for the VSP scheme. So this is the summary where the specifics of 100% payment or 110% payment before or after payments of December 2024 are there for tax purposes, and 25 to 30 and 30 to 35 for disputed interest or penalties is applicable. So these are the payment schedules that we have summarized, but the appellant, whether he is an appellant or as on 31st January 20 or not, are the specific dates which would determine most of the payment schedules. Whether he's applicable for the VSP scheme or not. And the payment schedules will be 100% before 24 December and 110% after 24 December for the taxes. There is only a 10% difference if you available in the column number, serial number 1 and serial number 2. But in terms of the interest and penalties, the difference they kept is 5%, 25 to 30 and 30 to 35. As on 31st January 2020, whether you are an appellant or not. From a VSP scheme standpoint, whether the appellant is eligible or not, and when the payment has to be made within 15 days from the date of payment, they have taken the extract or the intent from the past VSP scheme. However, this time they've specifically mentioned that this scheme will not be applicable for search cases, prosecution, wherever there is a dispute relating to foreign income and asset, whether there is a dispute relating to narcotic drugs and all, which may not be a specific case for transfer pricing as such. So my point is, wherever there is a jurisprudence which is applicable, whether it is applicable or not applicable, whether there is a coverage that is there, the more likely than not scenario will be the decision-making point for the VSP scheme to be taken for most of the transfer pricing cases. So ITAT filings, wherever the transfer pricing litigation is applicable, earlier it was 60 days from the end of the month in which you got the communication from the CIT or the DRP. Now it is 2 months from the end of the month in which the order, the order is communicated. The 60 days from the date of which the order is communicated was the existing provision. Now the proposed provision is 2 months from the end of the month. So they have extended the timeline by saying it to be specifically 2 months, and that too from the end of the month. Earlier provision was 60 days from the date on which it is communicated. So these specific amendment is kept effective from first day of October 2024. So 2 months from the end of the month is the revised timeline for filing the income tax ITAT appeal. From a revisionary standpoint on the 148 also, most of the cases, the timelines have been revised. So if at all any specific cases are there, we've just summarized it from a TP assessment, TP provisions angle is as such. But most of the cases, wherever 140 and 148A are there, and there is a revision that is applicable, the specifics of existing and proposed provisions are summarized for 148 and 148 as such. So all in all, the main amendment was specific to the streamlining of transfer pricing assessment. The general scenario wherein the 12 months timeline would be given as an extension is still applicable. However, from a TP assessment standpoint is concerned, the expectation that they would announce the entire streamlining of transfer pricing assessment is applicable, I mean, is expected from a separate notification. The 12 months timeline is still kept. The transfer pricing assessment proceedings as such, whenever they are streamlined, would be applicable for the specific dispute. I mean, the route of transfer pricing assessment would still be the same, or they will keep the DRP proceedings alive, or they are going to get it to the faceless mechanism. Whether the ITAT or the income tax appellate proceedings as such will be streamlined to be kept separate as a physical for transfer pricing assessments. All these aspects are due for a notification. So the point is, the transfer pricing assessments were kept out of faceless proceedings, first of all. So they were kept physical. All the transfer pricing assessments that are currently happening are physical. Now, they are saying that they're streamlining this transfer pricing assessment proceedings. Whether they will keep it in the NFAC or they will keep it away from NFAC is one point. Whether they are going to announce the dispute resolution process, that is the litigation process, whether they are going to keep it the same or they are going to keep it away from NFAC, and they're going to say that the CIT appeals also will be physical completely, because most of their files, wherever the transfer pricing litigation was there, and erstwhile, if we have applied for a commissioner appeals, they are still stuck at CIT appeals. They have announced a notification saying that everything has to be assessed or everything has to come back to commissioner appeals designated for transfer pricing, but most of them are still stuck. So there are complaints that have gone to the CBDT. There are complaints that have gone to the finance ministry also, and suggestions being given by the direct tax committee of ICI. So that they have considered this and they are analyzing all the provisions to be streamlined completely for transfer pricing assessments to be kept physical maybe, and then have the commissioner appeals also streamlined. All the cases of TP litigation will come back to the commissioner appeals physical. And then what about the ITAT also? So these questions are still remaining to be answered, and they have specifically specified that they are going to streamline the entire transfer pricing assessments. I was explaining the objective why they have kept it separate and they wanted to announce this separately is the fact that there are multiple questions that are being raised by the transfer pricing officers and also the assessees as such. So all these 4 questions need to be answered. That will be answered through the specific notification. So the powers of a commissioner, most of them, wherever there are 144 or best judgment assessment that are happening, commissioner appeals have been empowered that they can send back all these assessments and the timelines will be extended. Wherever there is TP, the timelines can get extended for 12 months. So the specific power has been given to the commissioner appeals or the JCIT appeals under section 251, and the amendment to the specifics of 153, the timelines also will get extended again by these specific timelines, which were, the erstwhile provisions of the assessment timelines. Wherever there is transfer pricing wherever the transfer pricing provisions are applicable, the 12 months extension also will be given. So these are the 8 amendments that we wanted to talk about from a transfer pricing perspective is concerned. Vidima, you're there?
Yeah, Mithilesh.
Yeah.
Thank you so much, Mithilesh. Let's just give a quick shout out to anyone who has any queries from transfer pricing.
Yeah.
Yes, everyone, the PPT, all the PPTs would be accessible. Those who have registered definitely will get all the PPTs of each of the session separately via mail.
Sure.
Just 1 second, let me just have a look into it. So there is a general question coming up. From an international taxation point of view, do you think the government will reduce tax compliances and simplify provisions for companies engaged in international taxation in future?
They're already doing 15CA, 15CB assessments. They're already doing surveys in income tax, international tax perspective. They are having a specific division on international tax as such. Wherever there is a cross-border transaction, if a permanent establishment is being questioned, all these assessments are happening. In a small jurisdiction like Hyderabad, we are having almost like 500, 600 assessments happening. So you can imagine Mumbai, Delhi, there'll be in thousands. So they're already doing it, but specifically applying international tax assessments other than the 15CA, 15CB foreign payments and the receipts and the permanent establishments and also the lower deduction and nil deduction certificates. Other than these 3-4 issues, there is no specific thing that can be added because all the provisions are getting assessed under the regular scrutiny itself. The specifics have been kept only for the international tax as a specific division. So I don't think there will be a specific assessment as such for the international tax provisions per se, but anything can happen. They can take a call that, you can do international tax assessment separately also. But I don't think so. It's a mere possibility right now.
Right. Another query, Mithilesh, I have given you on a direct chat box. If you just can give a look to it. It's regarding some timeline for filing appeal.
Timeline for filing appeal before CIT will increase from 30 days, but PPT slide shows 30 days. Okay, where is 30 days? I think they're talking about this chart. I think this chart needs a amendment is what they are pointing out here somewhere. Yeah, they are correct. We can change that 30 to 60 days. That should not be a problem. Yeah.
Okay, so Manish Joshi, if you're here, your comment is absolutely right. It is 60
yeah,
days.
we can mention that in this thing. Yeah.
Great. Perfect. Thank you so much. Thanks a lot, Mithilesh. It was always a pleasure to have you.
Thank you.